Hi, thanks so much for joining in. We're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. We're talking about mutual funds today, and specifically mid-cap and small-cap mutual fund schemes, and I'm talking about actively managed funds, of course. Now, when we talk about allocation or investment in broader market mutual fund schemes, we're talking, of course, about mid-cap schemes and small-cap schemes. The tendency of investors, and well, unfortunately, I have to admit, when we talk about it as well, we tend to clump them or we bulk them up into one single line. We say, okay, what is the inflow into mid-cap and small-cap? But the thing is, you should look at these two things very separately. You should approach investing in these two blocks very differently. I'll tell you why. But while I was preparing for this, I thought I would look at the benchmark, that is the Nifty Midcap 150 and the Nifty Smallcap 250, and just take a look at the major sectoral allocation for each of these two. And it seems like there is quite a lot of similarity. It's more or less the same, at least if you talk about the major contributors. Financial services accounts for about 21.5% in the small cap index and about 22.2% for the mid cap index. Healthcare is a similar allocation difference of less than a percentage point or thereabouts. Capital goods is again less than a percentage point difference. Chemicals, and we have this on the screen, of course, 7.3% for small cap and 6.3%. Information technology, maybe a little bit more in mid cap than in small cap, and consumer durables as well, more or less comparable. So where does the difference arise, and why should you look at things differently when it comes to mid cap allocation and small cap allocation, schemes wise? I'm joined today by Prableen Bajpai, who's a founder of FinFix Research. And Prableen, thanks as always for taking the time. This is a very interesting topic from my perspective, and I'm sure a lot of my viewers will be benefiting from this as well. In your opinion, should this be two separate approaches when you're approaching mid-cap investment and small-cap investment?
Hi, Alex. Yes, they should be separate. And because you've just touched upon the sectoral allocations, I'd like to add another index there and why we need to actually separate them out. Because when we're talking about mid caps, small caps, what you've picked is the mid cap index and then the small cap index. And small cap index starts from the 251st company, Alex, going up to the 500 company. But small caps are actually, as per the AMFI's data, small caps are up to those 6,000 companies which are actually there in India. So if we just go, one step deeper and then we just look at the micro cap index. Although micro cap index is there, but it is also small caps only. So, for the index, the constitution is a little different. So it's called the micro cap index. But there, then we see that there is a change in the allocations. For example, you just said that in the mid caps and the small caps for now, financial services was stopping at around 21%. When we go down, it is the capital goods which rises to 20%, financial services goes down. Healthcare reduces, chemicals and consumer durables increases. So I feel that the composition definitely changes, and small caps is such a big basket, that it'll be wrong to compare the 150 stock composition which we have in the mid caps with a segment which is 5,000 plus companies. And a few differences which are there, of course, from the sake of definition, mid caps are the 101st till the 250th company, and they of course are bigger in terms of their size, because the biggest company in the mid-cap space is around 99,000 crores. And the smallest mid-cap company is roughly about 33,000 crores. When we look at small caps, then small cap starts with about 33,000 crores of market cap and goes down to a market cap of few lakhs. So the segment definitely different. The kind of sector allocations that you will see is different. But when we look at the index returns and the trend, that is where, Alex, I think how and why people sort of club them together, because usually when large caps are not doing well, the performance of mid caps and small caps together is, much lesser. In times when large caps are doing well, we may see that small caps and mid caps haven't done that well. So usually it's the trend, the ups and the downs in the markets, which have, I think, resulted in this sort of clubbing together of these two segments. But individually, I think they represent so much more. And especially the scope of outperformance, given that in the mid-cap space, hardly any actively managed funds are able to beat the index on rolling return basis. None actually in a 5-year period on a 3-year rolling return basis, on a 2-year rolling return basis, one actively managed mid cap has been able to beat the index. But in case of small caps, it's different because the segment is much wider. When we are comparing with the index, the investment universe available to the fund managers is so much bigger. And that is why we are still seeing outperformance there. And I think that can continue for some time in India still. Although mid caps also, we do have some funds which are, in this market cycle, definitely beating the index. But overall, I think two of them should be treated differently and not always bundled together.
Let's delve a little deeper because this is very curious. I was speaking to, in fact, a couple of CIOs just earlier in the week, and I happened upon an interesting thought, right? Because you mentioned the size of the largest mid-cap and the smallest mid-cap. And for as long as I remember, we've been talking about the top 100 stocks as large caps. We've been talking about the 101st to the 150th beyond that. So basically the 250th is the mid-cap space. So the point that I'm making is that if you compare it with 10 years back, your smallest mid-cap is comparable with a large cap. And so should there not be a change in the definition? But having said that, we are still talking about, Prableen, the regulatory requirement to have mid-cap and small cap in those two categories, 65% minimum in mid-cap and 65% minimum in small cap. And the rest, the fund manager has ample room, do they not?
Yes, absolutely. So if we are talking through definition, then a mid-cap fund has to invest minimum 65% in mid-cap stocks, the 101st till 250th, and a small cap fund has to invest minimum 65% in any stocks which are beyond the 251st stock. So 65% has to be there. But Alex, what you mentioned earlier of the definition, I think yes, it's time, because with the AMFI's list, for example, what has come out in end of December, the last data that came out for the large bit and small segment, the categorization, I think definitely maybe the scope of the large caps needs to increase. The mid caps also, the universe needs to increase. And then small caps probably needs to be defined a little better. And then we can have, because we already have a micro cap index. So when you're having a micro cap index, it's good to probably define some of the stocks as micro caps and then rest of them as, super mini caps. So it'll be so much easier for the investors to know that what is their investment universe going to be. Because when they invest in a small cap fund, they probably don't understand that the universe is so large. And that is why it brings with it so much more risk as compared to a mid-cap fund because of this definition that we are currently having.
Investors on the flip side, Prableen, will say they have enough definitions already to contend with. If we add more, complexity, then we're not maybe doing them a good service. But having said that, let's talk about how each of these two categories have performed over the last 1 year. What are the top performers, and why have these schemes done well and beaten the benchmark? And once we do this, I also want to circle back to the point that you mentioned on mid-cap funds being unable to beat the benchmark on a consistent basis and why that is. But first, the deviation of portfolios you pointed out of the best performing mid-caps from the underlying benchmarks. Why has that taken place? Why has the outperformance taken place?
Right. So like I mentioned, Alex, on a rolling return basis, interestingly, only one fund in the mid caps has been able to beat on a 2-year rolling over a 5-year period. And none in terms of, again, the 5-year period on a 3-year rolling basis. But when we're looking at trailing returns, just for, simply understanding how the markets have been in the last 1 year, then we see that the mid-cap 150 index delivered delivered positive 5.79% returns in the last 1 year. But we saw the scheme which topped with 17.64% returns, followed by 14, 13, 12, and 11% returns. And I think what has been different for these, number one, let's look at the percentage overlap with the index. For example, Invesco India Midcap topped with about 17.64%, and it's got a 22% overlap with the index. And it is managed by their CIO, Mr. Tahir Badshah. And the highest allocation is somewhere between 3.9 to 4%. So not too high in terms of single allocation to a stock. Then it's a fund house which is really research oriented. They have so many interactions with sell side analysts, buy side analysts, and so they do a lot of these management conversations. And I think the mid cap here is the performance has been a result of the in-depth research that they've done over these years. Second, Edelweiss has been very different because it takes more aggressive bets into their stocks, and again managed by Mr. Niket Shah, a very well-managed fund, but they do have this 2 to 9% sort of a range of keeping allocations towards a particular stock. So they are more aggressive, but their calls have worked. And interestingly, Edelweiss has been maintaining a very, very high percentage of cash. So their cash holdings, Alex, has gone up to about 30% during this time period in the last 4-5 months, if we see. And currently, Motilal Midcap is sitting at about 32% cash. So again, very different approach. Then, for example, we have Edelweiss at 14%, very nicely managed. They have this combination of value growth and momentum together in their fund. So that approach of not sticking to a particular investment strategy, I think, has worked for them. And Nippon India Growth, again, at 11.92%. I think it's a legacy fund. It's got 30 years of track record with it, and one of the most consistent, schemes in the mid-cap space. So each of these funds have had its own reason of why they have outperformed. But sadly, in terms of rolling returns, none has actually beaten the index.
Why is that, though? Is that because of the investable universe being relatively limited? But and that is the case ultimately with large caps as well. But is that the case for mid caps?
Yeah, I think, Alex, definitely one of the reasons is that it's a 160 stock universe that they have, but they do have the they do have the free hand of moving outside that 65%, and that 35% can be large caps or it can mean small caps. Ideally, theoretically speaking, there should be outperformance given the kind of freedom that they have, but they have not been able to do that. And I think this is why in India we say that, as markets mature, and what we've seen in the West also, with time, passives will rise, and the outperformance definitely is shrinking, and it is clearly visible in the mid-cap space. And then obviously, Alex, there are also times when things don't go right, when market moves up, too fast. Sometimes the allocations are not, they're not able to change the allocations that aggressively. Sometimes cash calls are taken, which don't work. So, there'll be multiple reasons why this is happening. But the ultimate thing is that I think it's a very tight index, which now they need to beat. And they're not able to do that.
Yeah, incidentally, on the allocation side, what we pulled up is as of March, and we've looked at all of the schemes in the mid-cap universe, the allocation is about 67%, interestingly, to mid-cap. So they're relatively underweight on mid-cap. Most of the schemes in the category, there are a few. Yes. Of course, Edelweiss, since we mentioned and we spoke about it, is at 74% or very close to that mark. But Franklin India is at 65% allocation to mid-cap. And for the category as a whole, they have a small cap allocation of about 14% and a large cap allocation of about 12%. So that kind of tells you the fact that they are having to venture beyond the universe, Prableen, as you pointed out, of yes. mid-cap to try and generate that alpha. Is this story a little different for small caps?
Slightly, yes, slightly. Number one, that in the small caps, Alex, we are seeing that even on rolling return basis, the outperformance of more number of schemes is there as compared to the index. So there is high potential still, I feel, in the small cap space because of the depth of the, the space in terms of the number of stocks that we have. So again, in a 5-year period, if we see on a 2-year and 3-year rolling windows, we are able to see that about 7 schemes are able to beat the index when we are talking about the Nifty 250 small cap index here. So 7 schemes have been able to beat. But if you look at the trailing returns, interestingly, Alex, the outperformance has been quite stark actually, because the Nifty Small Cap 250 index has already only delivered about 1.29% returns in the last 1 year. But Motilal Small Cap, Bandhan Small Cap, Invesco, UTI, and Axis, the top five over this 1 year period have actually delivered, some 16%. Coming down to 9%. But one more thing which needs to be seen here, that while we're talking about the outperformance, Alex, even in case of mid caps, we saw that the highest was 17.64 in the last 1 year. But then you also have an actively managed scheme, which is negative 5.07. So when index is giving you 5.79 positive, this scheme in the last 1 year has given negative. So, that kind of a stark difference we are seeing in the returns. In the small caps, the lowest return has been negative 3.44%, as compared to highest 16.69%. And again, Motilal has been the topper here. Motilal was, it's quite a recent scheme. It was only launched in December 2023. So it's just about a year and a half old, and with a 4,000 crore of AUM. Again, concentrated bets, very, very high proportion of cash that they are holding. Currently, again, Motilal is holding about, in the small caps, it's slightly lesser than what they've had in the mid cap. It's about 9.2% with about 10% allocation to mid caps. Bandhan, again, I think, their CIO has been managing. And Bandhan, Alex, over this time period, since Mr. Manish Gunmani has taken up the scheme, has really, really expanded its research team, and I think the number of stocks which were under its coverage. So the portfolio has also, size has substantially gone up. And now I think it's close to about 170, 180 stocks that they have. And a small allocation with top 10, not more than 30%. So the allocation structure is different and it's worked well. They have about 10% of cash currently. Invesco, again, a good fund house. Like I mentioned, they've been able to maintain their consistency in performance. UTI, again, not a very old fund. And Axis, they all have been able to beat the index very comfortably, along with some other schemes as well. But I think the main point here is that the strategy which they followed, for example, UTI, quality and momentum, they have the scope for governance. They have the scope to look at the management. So I feel in small caps, this potential that the fund managers hold, and so much that can be done by them, I think is so much higher. And that is why I think, solid research in the small caps is so crucial for being able to deliver the kind of returns that investors actually desire when they take that kind of risk.
Okay. So, Prableen, incidentally, we spoke about small caps earlier in the week as well. And we spoke about the factor of lower duplication of portfolio. So the potential for having more than one small cap fund in your portfolio and not having duplication of portfolio is there because the investable universe is much larger. That really was the crux of the conversation. But when it comes to the actual nitty-gritties of it, I think the one question that a lot of people ask is, where does a mid cap fit in my portfolio? Where does a small cap fit? Small cap obviously is a satellite or an allocation that is supposed to give you that alpha in your portfolio, right? It's not the core of your portfolio. Can you have a large cap and a mid cap allocation and ignore small cap? How do you go about it?
So mid caps, definitely, they are the large caps of tomorrow, Alex. So I think they hold a very, very important position in a portfolio. So it has to be the core. So I would put mid caps as the core in my own portfolio, along with large caps. And when it comes to small caps, then definitely, I think the percentage allocation depends on the kind of investment tenure that the individual has. So in mid caps also, we say, it should be at least 6 to 7 years of investment horizon that you have. But I think in small caps, that becomes even more crucial because the falls are so much harder. Because we've seen from 2018 till 2020, that period, because 18-19, we didn't see great performance by small caps. And 2020, we saw COVID happening. There was this 60% sort correction overall. So you should have that kind of a time period. And, we've also spoken about this, Alex, that for 3 to 4 years, sometimes the returns in small caps can be so disappointing. So you have to take allocations to small cap. It can be even starting from, let's say, 5% to 10%. We do have portfolios where small cap allocations are also as high as 20%. But I think it depends on, as an investor, are you a beginner? Are you a savvy investor? Do you really understand your risk appetite? And without a hard fall in the markets, usually we have an illusion about the kind of risk that we can take. So it's important to keep it at a low level only if you have a 7-year plus horizon, and then gradually increase probably once you understand. But yes, life can move on without that allocation as well. I think if you have the mid caps, but I think a small cap can definitely add that bit of an extra alpha to the portfolio, given the style and the stage at which we are in the Indian markets, Alex. I think small caps are an important segment also because some of the sectors, like we discussed initially, are not that well covered by the large cap space and in the towards the larger segment basically.
Okay. Absolutely, and a lot of companies will enter the fold over the course of the next few years. Hopefully, I would hope, and broaden and deepen the capital markets here in India, because ultimately one of the big challenges, probably for small cap fund managers, is the requirement to deploy funds. They've been unable to do so, and that I think is an important point to make as well, right? Because if you are investing today into a Nippon India small cap fund, then you can only do so in the way of a SIP. You cannot do so in the way of a lump sum, because they've said
a lot of them have actually restricted
off the top of your head. Can you remember which ones have restricted?
Yes, because we deal with it, Alex. So SBI small cap for many years now has actually this limit of 25,000 a month, whether you do an STP or SIP, and they don't take lump sums. Tata small cap, they don't take a lump sum, but they don't have a capping on the SIP and STP. Nippon has its limitations that you can only do an STP or an SIP without the amount limits. They are not. There's no rigidity there. But these three are the top ones which come to my mind in terms of the restrictions which are there.
So when it comes to, and I'll circle back to how you choose between the two, right? But when it comes to small cap, the CIO that I was mentioning, and in fact it was Shailesh Bhan, and what he was saying is that he feels, for obvious reasons, that the outcome for an investor in a small cap fund would be better in the way of a SIP approach, which is why they've taken the steps that they've taken. Apart from the fact that I was mentioning, it's tough when you are trying to deploy funds, as you've pointed out, at the broadest end of the spectrum, when you're talking about a market capitalization of 2,000 crore, even 2,000 crore, right? Yeah. So if you want to deploy 1% of the fund value into this scheme, then you're effectively taking a very large holding. Yeah. So from that perspective, do you think that SIPs are the way to go for small caps?
I think SIPs definitely reduce the risk for investors. So talking from an investor point of view, Alex, because a lot of recency bias is there. So, you get trapped. Retail investors see that what happened in, let's say, 2016, 17, and then they deploy in 2018. So 2023 was spectacular for, mid-cap, small caps. Then we saw, of course, 2024 was also great. And then the deployment starts and the hard fall comes. I think it's if you're doing an SIP, somewhere mentally you're prepared. If with that 5-7 year horizon in mind, I think you're able to do the averaging in a better way. And I think it definitely reduces this averaging, definitely reduces the risk for retail investors who can get trapped in this recency bias by seeing the 110 and 120% returns and going in with a 1 year horizon. So that's suicidal. So I think SIPs and a staggered approach, even in these markets, Alex, we're really not sure of how markets would move in the next 3 to 5 months, let's say. So I think if you want to deploy, you do have a long time horizon. A staggered approach can be so good via an STP. And I think the discipline automatically comes in, and that mechanism takes care of that you're not over deploying in times when markets are pretty high.
Okay, winding down now, and this is the last part that I want to address, Prableen. This has to do with mid-cap allocation and small cap, of course. Since you've brought up the data point, unfortunately, these fund managers and no fund manager has been able to beat consistently the benchmark. From that perspective, would you say that a passive approach is something to consider in mid-cap for sure? I know that's the argument in large cap, but is it the case for mid-cap as well?
We've been doing that for quite some time, actually,
Okay.
Alex. That we are actually taking the passive call even in the mid cap space, and it's worked quite well. And if I have to deploy money for myself or for my family, I would do it in the mid cap space, passive fund. So I think the 150 index is a good place to invest. And if you can have a bit of a higher risk, and if you are okay with the variation and trying out something new, then even the mid cap 150 momentum index actually looks good. But standard mid cap 150 index, I think, can be a good call, especially for investors, Alex, who have this 7-10 plus horizon. So let's say if you tell me that you're investing in the mid caps for 6 to 7 years, I would still say okay, maybe an actively managed fund can work. But if you're telling me that it's for 10-year and beyond, definitely a passive fund. So I would say it also depends for the kind of horizon that you're investing, and it's better to stick to the index than chase returns of the best performer, every now and then, and be bothered, especially given the kind of difference in the returns, Alex,
Yeah.
amongst the best and the worst performer that we are seeing. I think
Certainly.
that is worrisome, honestly.
Yeah, certainly. And cycles and their orientation, of course, determines whether or not they're top of the cycle or bottom. But the last point, which is small caps, and relatively quick answer here, Prableen, I'm guessing that you may not necessarily like some of the schemes that we've discussed today, or maybe they'll form part of your list. So if I were to ask you, what are the schemes that you pay attention to most, not recommendations, but what have you watched most closely, and what have you most advised to your clients to hold?
So out of these, I would say we do have Bandhan as one of our recommendations and Invesco currently. Axis also has been on the list for some time, although with a reduced allocation. So out of these five, and three are there actually on our list as well.
Right. So I think we've had a pretty holistic conversation about the mid-cap and the small-cap space. Prableen, as always, thank you so much for taking the time.
Thank you. Thank you so much, Alex.
All right. I hope that this conversation has been beneficial to you, particularly because I'm sure that you might have some of these schemes, or in fact, some other mid-cap or small-cap scheme. If you've got a specific question for us about a topic that you'd like us to take up on this program, then don't hesitate to write in on the comments section. In the meanwhile, do stay tuned. This is NDTV Profit.